leveraging. Oh, now the recording. So this is the track on leveraging corporate governance and the role of boards. So we have 3 speakers today, and each of you will have 10 minutes to present and then 5 minutes to have a question and answer specific for each of the papers. So it's not a lot of time, and therefore let's move on quickly. I would like to introduce first Hanya. I'm sorry if I'm not pronouncing it correctly. Mr. Habeb Yanya. So he comes from the Turku School of Economics, and he will present the paper CO Board Characteristics, examining the role of women in the sustainability performance of firms. So Habib, the floor is yours.
Okay, well, this is surprising. I wasn't expecting to present first, but anyway, it's fine. And well, you managed to pronounce my name fairly well. It's Habib Yahya, but anyway, that's not so important now. So I'm going to share my screen now if you allow me to. Yes, yeah. And, can you see my screen, please?
Yes, okay. Yes, we see the it's a PDF.
Okay, so I don't know. Can you see my screen?
Yes. Now you're typing the password.
Oh, sorry, I don't know what happened. So I think it's okay. Now I want to enter full screen mode. But anyway, if I'm not able to, so I don't take much of the time, I'm going to go ahead to present
I think, Habib, if you go to view, maybe you can make a full screen.
Yes,
now
yes,
it's full screen. Thank you very much.
So basically, from the time that this paper was submitted till now, I've had the chance to present it in a conference and at least a workshop. So there are some work in progress still, but basically the title now is about women leadership and firm ESG performance. So I'm looking at this in the Nordic countries. So we have in the Nordic, we have Norway, we have Finland, we have Sweden, we have Denmark and Iceland. Well, and as we all know, this is a region that kind of try to lead in aspects of sustainability, especially in issues relating to gender diversity and the rest. So, but basically, what I'm doing here is to examine the impact of female leadership on ESG performance of firms. So, and why I think it's essential because much focus has been really on gender diversity. So there's still a bit vacuum in female leadership. So when I say female leadership, I'm talking about female in position of board chair and CEOs or even CFO, as I'm now considering as well. So I use this term that it's still the role of the pawns and not the queen. So we are still saying, okay, we are talking about gender diversity. We just want them on the board just to fill up the numbers. But how about looking at how their position as decision makers affect the performance of firms in this regard? So, and I try to look at the potential reverse causality, or at least potential reverse correlation that can be the case, especially if you look at the tendency that because of gender quota laws and similar regulations, it could be so that only firms that have women in as members of boards are the ones that have CEOs or CFOs or even board chair as female individuals. But anyway, I try to use data from publicly listed firms between 2010 through 2020, and the basic approach in analyzing this relationship is the linear regression or parallel regression approach. And of course, this is an unbalanced parallel regression because, of course, there are years where there are no data on ESG scores of some of these firms. But basically, these are the main findings of my research. Well, I found that firms with female leaders have overall ESG scores. That's probably not too surprising, but the interesting thing is that only in social scores of ESG, I mean pillars of ESG, did I find significantly higher scores for firms. So what I'm saying here is that when we look at the environmental pillar scores, there's no difference with women or men as leaders in these companies. Well, that's reasonable because if you think about the regulations around and the demand around environmental sustainability, it's probably obvious or at least reasonable to think that firms, regardless of gender difference, will still abide by certain regulations and principles. And in that regard, there might be not or no significant relationship to gender of the leaders in these companies. So, well, I found no reverse correlation between female leadership and ESG scores, which is a good thing at least, and characteristics like tenure of these leaders is really affecting the performance of firms, which is also very reasonable. So it means that when a board CEO or a board chair or CEO, or in this case CFO, is in position for quite a longer time, it kind of tells on the performance of firms in these ESG issues. So, well, I think the most important thing that I want to point out on this slide is that this result is validating that in comparison to men, women are more concerned about others in research. As research in psychology has shown, I mean, this is an earlier research by Gilligan in 1982, and they also, other research like Igley and Carley also showed that when there are alternative perspectives, women try to give greater consideration to fairness. And I think when we talk about sustainability, it's right to think about these social issues and how we put more value emphasis, or we have been talking about stakeholder capitalism in a sense. And if stakeholders are not getting monetary benefit from the company, how do we try to give incentives to them in kind of the social aspect? And this is quite essential to this research, I mean, the findings. Then basically, these are some related literature, which I'm not going to go through because of time, but at least these are things that are, I mean, studies that have been done that are at least closer to, or at least connected to what I'm doing here. And I have two main hypotheses. The first one is that I expect that firms with female leadership have higher social scores than their male counterpart. I mean, than if you compare them to firms with women in position of leadership. And secondly, I expect that there should be no significant difference. For example, if you look at the EU taxonomy, that knows no gender, for example. It's binding on companies. And if you still look at social issues, there are still no definitive guidelines or regulations on how firms should behave in social issues. So we still expect that these leaders and companies, by way of decision-making of managers, are still going to have some strategies in this regard. So what I'm saying here, I'm pushing here, is that in retrospect, if you look at both men and women tend to quite be more empathic. I mean, when you look at how they consider these social issues. Then, well, this is the data, and the variables are the ESG scores. Of course, this is the dependent variable. I have used a dummy to capture the female leadership. Like I said, the research is still in progress, but at least I have initial results which I'll be showing you. So in the new studies that I'm carrying out in this regard, I've included CFO because, of course, I want a more robust sample. And we all know that the number of women in positions of leadership, if you look at only CEO and board chair, is still very significantly low. And I don't want something that is going to be coming from sample selection bias, at least. So I'm expecting that the results will be consistent, but at least for now, I'm presenting what I have. So basically, I include, of course, when you are doing studies on that is related to board characteristics, you have to put some control in place, like age, tenure, and these are the ones that have been included here. I also included firm controls and country controls, which I will not be going into in detail. So the first result is testing the first hypothesis. And as you can see here, at different times where I've included different board characteristics, of course, and with the controls, I've included firm fixed effect, and the year and industry, firm and industry fixed effect here is firm times industry. So of course, if you are using firm and industry in the same models, you can have already correlation between those two. So you don't expect any significant impact. But what I'm doing here is firm multiplied by year. So that can be done econometrically. But what I'm going to say is that except where we have board independence, which of course is almost a given in a sense. In all other models, we can see that there is a significant relationship between female CEO of Watcher and ESG scores of firms. So this is confirming my first hypothesis that these firms have significantly higher performance in social-related issues when compared to firms with women. But in the second hypothesis, where I expect no significant difference, as you would see in the first result, I mean, in the result in the relationship between firm CEO and board chair, you will see that there's no significant relationship. Of course, there is positive economic relationship, but we are looking at how significant that increases, and we find no significant relationship here, which is something that we should expect given the issues surrounding environmental sustainability of firms, which goes beyond gender difference. And well, the overall ESG score, as I showed, of course, this can be expected. At least something is driving this overall ESG, which of course we are seeing that the social performance of firms differs when they have female board chair or CEO. So it could be expected that at least that drives some results in that sense. So, and this is where I test the reverse correlation between these variables. What I'm doing here is to change the dependent variable. So now I have this dummy that's capturing the female board chair or CEO in position of leadership, and I'm testing whether those firms that have high scores are the ones that are appointing female board chair or CEO. And as you will see in the overall ESG score, the environmental score and social score, there's no dependence in that regard, which is something that proves that this result can be at least relied upon. And in conclusion, well, this study validates the claim that women are more concerned about others, as we found higher scores in social pillars scores of ESG with female leadership. That's something that I already opined in the hypothesis. So, and similarly, there's no significant difference between firm performance with or without women as leaders in companies. And well, these are quite important variables that we can look at and take into account when we are doing these studies in the future. And I think essentially what I will close with will be that one of the interesting things or inferences that I will draw from this is that if we look at other issues, even in sustainability, in environmental issues and governance issues, I think a lot of them are still coming from empathy. So we need more of these people who are sensitive to social issues like inequality, human rights, and stuff, for us to be able to at least yield to the plight of the general public as regards sustainability, which in a sense, I think it's progress for us. Thank you for listening, and I look forward to your comment and discussion. Thank you.
Thank you very much, Habib, for your presentation. It was very interesting. Are there any questions? Please write it in the chat or just turn up your mics. So meanwhile, if you are thinking about questions, I will start. First, thank you very much, Habib, because this research seems rather interesting. Seems quite interesting, and it's a good contribution, I think, for businesses to understand the role of policies for equality. So the first thought is, in what context were the data collected, and what is the profile of companies? Were they from Finland, or is it an European or global? Or
yeah, okay. Well, this is a good question. Of course, if I had more time, I would have shown my descriptive statistics, which will give more insight about it. So, like I shared in the beginning, these are Nordic firms that are listed on Nordic exchanges. So, but what I've done is that, of course, they are publicly listed firms because you typically have ESG scores for publicly listed firms. But what I did is that these are not only big firms, because we have what is called first not exchanges, so which are exchanges for small or at least medium-sized companies. So what I did is that I collected data on both bigger firms and of course medium-sized firms, at least to capture this, at least to omit the size effect in performance of firms in the ESG. So basically, they are European firms that are listed on Nordic exchanges, where Nordic exchanges are Finland. Nordic is Finland, like I said, Sweden, Denmark, Norway, Iceland. So that's the 5 Nordic firms, countries. Right.
And the other question is because you said that your research was expanding on the previous research and it broke new data, but and also you validate the existing research on gender equality. The existing research that you looked at, the focus was also in Scandinavia and the Nordic countries, or were you able to find other researchers from different
No, of course, most of the earlier researches are done on the United States economy. And one of the interesting things is that I didn't go through that in the literature review. They have only focused essentially on the environmental performance of firms in sustainability. And as you would know, I think this is always the case when you go into sessions. I've been in many of them. It's quite interesting. And that's one thing. Kudos to ABIS because it's not just about environmental sustainability. We are talking about sustainability in general. So we're talking about social issues and even governance issues. So in most cases, when you attend seminars, workshops around sustainability, it's always about reducing climate risk and emission and stuff like that. And there's a little credence to social issues. And I think a lot of issues that are abound in the world today are coming from, if you look at the Ukrainian war and the invasion of Russia, these are quite sensitive social issues that I think we have to be careful and pay more attention to addressing. So, yeah.
Yeah, thank you very much, Habib. For I don't see any other raised hands. So last minute opportunity to move to the next presenter.
Okay, thank you for listening.
Yeah. No, thanks to you for presenting and for your research because it's very interesting. Maybe we can make you new questions after it because there are no raised hands, but after at the end, we may have questions to the three of you, the three presenters. So we can come back to you later. But yeah, thanks again. So our second presenter is Hans. I'm sorry if I'm mispronouncing it. Taparia. Or yeah. So Hans is from the New York University and from the Stern School of Business, and you co-author a presentation together with Bruce Buchanan, Community Governed Capitalism Using the Butterfly Charter. So yeah, Hans, the floor is yours.
Thank you, Joseph. Nice to meet everyone here. Thank you, Habib, for your presentation. We start this presentation with a quote by Louis Brandeis, who many of you will know as one of the giants of the US Supreme Court in the early 20th century. He's well known for his work on the right to privacy, but also for his bold and cutting-edge work fighting monopolies and corruption at big corporations during the Gilded Age. He understood early on that while corporate bigness creates economies of scale, it also can make them less innovative, impossible to manage, and often less likely to serve society. He states that only through participation by the many in the responsibilities and determinations of business can Americans secure the moral and intellectual development which is essential to the maintenance of liberty. This quote embodies the work that we hope to present to you today. Now, it turns out that we're living in the midst of another Gilded Era, hopefully one that is beginning to wane. And the costs of market inefficiencies externalized to society are gargantuan. Market failure is pervasive. Now, we argue that the problem may not be capitalism itself, but perhaps what we may call a monoculture of corporate designs as it relates to the foundational elements, such as who owns a business, how is it chartered, how is it governed? Today, most corporations are owned by faceless institutional investors. Most are chartered as C Corps or LLCs, and most have a singular fiduciary duty to produce shareholder returns. But if corporations were designed differently, we may see different outcomes. So to mitigate inefficiencies, we propose a new set of corporate designs under the umbrella that we call the community governed corporation. Now, just to give a sense of these market inefficiencies, just a few examples that just scratch the surface. But if you start looking at this, you realize the situation can be quite costly. The food industry, for example, is externalizing over $2 trillion of costs onto society. That's more than the revenues the industry generates. Tobacco, still externalizing or levying $600 billion of costs onto society. The costs of oil and gas, quite substantial as well, probably an underestimate here of $1.1 trillion. Plastic is an interesting industry. It's about $600 billion in revenue, but externalizes $3.7 trillion of costs to fisheries, ocean acidification, and so on. And we assert that the root cause of what you might call indefensible market inefficiencies goes back to a singular problem, which is the relentless fiduciary duty to the shareholder by management. Now, with that in mind, we propose a new design that acknowledges that investors or shareholders are arguably of most value at the early stages of a company, but that those very same shareholders are often the source of societal costs at the later stage of a company. In the early years of a business, investors can bring capital and help attract talent, giving a jumpstart to young companies. But as a business matures, its penchant to maximize profit is what tends to create societal costs. So we propose what we're calling a two-stage charter, the butterfly charter. Stage one is where the company is owned by investors and governed by investors, again, bringing capital, helping attract talent. But once the company is mature and generating healthy cash flows, the stakeholders or the company itself can actually buy out all of the investors through some combination of earnings and debt, essentially eliminating shareholders completely. And at this particular stage, the company is entirely governed by stakeholders and becomes shareholder-free. Now, we call it the butterfly charter because stage one, which is investor-owned, is the larva stage. It's the stage where the company is incubating. Stage two is the butterfly stage because it no longer has a fiduciary duty to the shareholder. It is free to fly in any direction based on the needs of the community. Now, to contextualize the CGC, or the Community Governed Corporation, it's useful to get to do a quick outline of the landscape of benign designs. And if you look at this, non-for-profits, they've been around for many years. For centuries, they're charitable or educational, religious, scientific, social institutions that aim to reverse the outcomes of market inefficiencies. But they do have limitations. They tend to rely on donations, and donations are necessarily a small fraction of profits that are often generated through indefensible market inefficiencies. Social enterprise is an interesting design as well, for-profit companies that have a mandate to reduce social costs. The mission may be enshrined in one of those design elements, the charter, for example, benefit corporations, B-Lab certification being examples of this. But they have little legal recourse if they don't live up to their charters. And once again, they require the consent and therefore the benevolence of shareholders. Cooperatives are an interesting benign design. These are for-profit companies that have no external shareholders. They're owned and governed by one or more of the stakeholders. However, they're hard to get started. Stakeholders often don't have common goals in the same way investors do. They often don't have the expertise to run businesses, and therefore that early stage cost of collective action is high, and they're hard to raise capital for. ESOPs are another form of stakeholder ownership, employee ownership in this particular case, but once again, their creation is at the discretion of management, which have a fiduciary duty to the shareholder. So you can see within this landscape where the CGC might play an interesting role. Now, our work is built off of the work of a law scholar at Yale by the name of Henry Hansman, who wrote a book called The Ownership of Enterprise. And he states in the book that efficient business design minimizes the sum of both the collective action costs of ownership and governance and the social costs of market inefficiencies. It must minimize these two elements here. And if you look at the design of an investor-owned corporation through the course of the business life cycle, you find that the cost of collective action upfront is actually pretty low because investors are aligned on a profit motive. But once the business matures, the cost of inefficiencies is high because the business saturates its marketplace and the profit motive drives those inefficiencies. The stakeholder-governed corporate design is almost the inverse. You find that the cost of collective action upfront is very high because stakeholders often don't have common goals, as we mentioned, like cooperatives, and require training to operate businesses. But once they make it over that hump, the cost of inefficiencies is low over the longer term because stakeholders have no fiduciary duty to shareholders. So the CGC attempts to take the best from both these worlds, where if it's investor owned in stage one, the cost of collective action is low. And if it flips to stakeholder governed, the cost of market inefficiencies also has the potential to remain low over the longer term. And so that's the idea behind the community governed corporation, making it the more efficient design. Now, we should state that these stage two designs exist all around us. We have corporations that are owned by stakeholders, such as Organic Valley, John Lewis, New York Life, cooperatives. There are some corporations that have no shareholders at all. REI is an example of this, which is member-run entirely, no stakeholders, looks a bit like a nonprofit. Mayo Clinic started as an investor-owned business back in the late 1800s, early 1900s, and flipped to a nonprofit in the 1920s. Making it stakeholder governed. Patagonia is another interesting example that was owner driven for 50 years, donated to a nonprofit in its stage two, if you will, and became stakeholder governed more recently. However, none of these companies had envisioned two-stage charters from the beginning, and that's what we look to do with the CGC. As a result, we argue that many of these took decades and decades to develop. Now, CGCs can be formed either anew, through what we're calling CGC creation, and in this case, the terms of the buyout for investors would be predetermined. We think this is a very powerful way to unlock a lot of mission-driven capital, particularly into lower income communities, where businesses can be incubated, but the terms of the exit are determined for investors to help them find exits. We also think lots of existing corporations, small and large, can be flipped or converted to CGCs through stakeholder buyouts. Imagine a corporation like Hospital Corporation of America, a very, very high cash generating business that stakeholders could in theory purchase and make it entirely stakeholder governed so that it can serve its community better. BNSF Railroad, another example of a very cash rich business that's about to go on strike. That could also be flipped and become stakeholder governed. Just examples of companies, insurance companies, railroad companies, healthcare companies that could be flipped. I'm going to stop right there. We've got a couple of examples of applications of CGCs, but I'll stop there for some questions.
Thank you very much, Hans, for your presentation. And again, I would like to open the floor for participants to raise their hands or just unmute yourselves and drop some questions. Yeah, meanwhile, while everybody, hello, yeah, oh, sorry, I've got a problem with the sound. While people think for a question, so what's your opinion, Hans, about how the different models that you presented perform? Do you think they perform equally in front of the different societal challenges? Like, do you think cooperatives are better in, for instance, answering to environmental challenges? Or what is your connection between the challenges and the kind of governance forms?
We think that if a corporation is stakeholder governed, the members of that board could represent multiple stakeholders. The environment could be represented on that board. Workers, community members could be represented on that board. And certainly it would tend to slow things down a bit. But we think that those decisions that board would make might be more deliberative and yield better outcomes, depending on the purpose of the corporation at that particular time. The idea behind the CGC is to carve out a portion of the economy and eliminate it from faceless institutional shareholders. That's the idea here.
Thank you very much. There is a question in the comments from Habib. I was wondering what are the likely pushbacks from this proposed shift?
Well, I think the most important thing is that there need to be funders who are willing to support this. We argue that the Achilles heel of a shareholder is that they have to sell when presented an attractive offer. And so if stakeholders were willing to present an attractive offer to buy, they would have to consider it. And if there were funders who were willing to support stakeholders behind that, then that would work, but there would have to be funders. Now, that market has been proven. The market for leveraged buyouts, KKR, Blackstone style, is well established, and that operates under the same premise. Of course, in this case, we're looking to do this in a way that eliminates shareholders completely, so that the business can serve stakeholders.
Thank you very much for the answer. I see that Mr. Arnold Smith, you have your hand is raised.
Thank you, Joseph. Thanks, Hans, for an interesting presentation. I just want to know whether you have, for instance, done any comparative studies in terms of dispensations elsewhere in the world, because I think there are interesting developments. Normally, from a South African perspective, when we think about corporate governance and we think about the shift from shareholders to stakeholder inclusiveness, we would compare, for instance, with the US and the developments there. We would look at the Cadbury Code in the UK, for instance, and relevant legislation. We would be looking at the two-tier boards in the German dispensation and so on. So might some of the answers that you are looking for not perhaps be less radical and already encapsulated in formats and approaches that are being tested or even well established already in other parts of the world?
Thank you for that, Arnold. And I would welcome other ideas that you may have. We have done a very preliminary survey of that. The German model of co-determination, of course, very interesting. The US does not have any laws that require corporations to give stakeholders any governance. And so the US, of course, 12,000 lobbyists in Washington that will try to prevent that. And so this is a model that we think could be interesting for the US because it leverages the marketplace to bring in stakeholder governance. But there are many pioneering models across the world. There are also pioneering models within the US and elsewhere in the world as it relates to trust level governance, purpose-led governance through trusts. And you see that across the board with single corporations, the Tatas in India today, the Patagonia in the US, all interesting examples. What we're trying to do here is codify all these models and see if one can look at this, one can implement this with intention, across the broader economy.
The big question, of course, is whether a company is ever being owned by shareholders, which is a debate which is raging in the US itself.
Yeah, we have to find a way to buy shareholders out. And we think that, buyouts are one way because, if there's an attractive offer on the table, they have to consider it. That is their fiduciary duty. Thank you.
Thank you very much, Hans, for your presentation. I don't see any other raised hands, so we can go to the third and the last presenter, Mrs. Lara Giannina Reyes. Lara, are you?
Thank you.
Yeah, thanks.
Yes. Okay. Am I audible? I'm sorry, my internet connection I think is a bit unstable. So am I clear? Am I being heard?
I hear you super well and I see you very well. So
thank you. Good afternoon, everyone. I am Lara from the University of the Philippines, Los Baños, and I will be presenting a case study on the Institute of Corporate Directors Philippines. And the title of this presentation is Overcoming Conformance Inertia, Pushing Philippine Boards Towards Stakeholder Value Creation. And as we know, Philippine businesses have been dominated by family firms for many years. And that, along with other companies, need to be professionalized. However, corporate governance as an agenda of the private sector in the Philippines only really took off in the past 20 years. And we have only really seen significant regulatory milestones in the past decade. So this is a timeline of both regulatory and non-regulatory milestones on CG in the Philippines From 2012, the Philippines has launched its participation in the ASEAN Corporate Governance Scorecard, along with Indonesia, Malaysia, Singapore, Thailand, and Vietnam. The following year, our Securities and Exchange Commission finally required publicly listed companies or PLCs to submit their annual corporate governance report. 2 years later, the SEC finally launched their 5-year plan, or the corporate governance blueprint, detailing their vision to strengthen governance in the Philippines. The following year, we see the implementation of the Code of Corporate Governance for publicly listed companies, using principles from international best practices. And right before the pandemic in 2019, there are 2 milestones. The first one is the revised corporation code has been passed into law under the Duterte administration. And the second one is that our country's SEC has released its sustainability reporting guidelines as a requirement for publicly listed companies to attach to their annual report. Just a quick background and profiling on the subject of this case study. The Institute of Corporate Directors was established in 1999 in the aftermath of the Asian financial crisis. And its objective is to professionalize corporate directorship and to raise corporate governance standards in the Philippines. It has now over 100 or 400 fellows, which are the source for independent director candidates for different companies. And it is the accredited corporate governance trainer of the following regulators. So you have the SEC, the Bangko Sentral ng Pilipinas, which is the central bank, the Governance Commission on Government-Owned and Controlled Corporations, and the Insurance Commission. ICD is the source or the main knowledge resource for the different reports and the different studies and director surveys for corporate governance in the Philippines. It also offers corporate governance education, which professionalizes aspiring independent directors. And for companies, it offers services on board evaluation and what they call a strategy execution pathway, which is about trying to help companies craft board protocols, trying to help them with their corporate strategies, etc. And finally, ICD tries to pursue its advocacy through its committees. So these committees are the subject matter experts of different fields of business, of corporate governance, and they act as recommending bodies for government policy, standards, and regulations. So you have the board and diversity inclusion committees, you have the technology governance committees, you have the corporate governance scorecard committees, etc. So that is just an overview of ICD Philippines. And the main or defining feature of corporate governance in the Philippines is the ASEAN Corporate Governance Scorecard. And the ACGS was jointly developed by the Asian Development Bank and the ASEAN Capital Markets Forum, which was benchmarked according to international best practices. So these 2 highlighted parts of the graph are, the first one in orange is the top performing country, which is Thailand, and the blue one is the Philippines. So this starts in 2012 with the Philippines in 4th place. And as you can see, by 2017, the ACGS has become more stringent in its standards. Nevertheless, despite the downward slope in 2017, the Philippines continues to rise in its corporate governance performance, showcasing its commitment to further better or strengthen its governance of companies in the country. This other graph now shows the ACGS scores on the 5 assessment areas of the scorecard, and it is about the top 100 Philippine publicly listed companies. Although ICD says that the corporate governance landscape in the country has significantly improved over the last 2 decades, looking at the 5 assessment areas, the top 100 publicly listed companies until 2019 scored high on the equitable treatment of shareholders and protecting the rights of the shareholders. This is in contrast to placing an importance on the role of stakeholders. So this indicates persistent shareholder centrism, and up to 2019, there is low stakeholder priority. Thus, when ICD was asked in the interviews, what do they think or what is their outlook on the transition of the Philippine business sector to this new era of stakeholder capitalism, ICD sees this transition as something inevitable, but it will be very challenging for Philippine business to transition to this new era of stakeholder capitalism. And this is because companies are still tied to conformance in terms of regulatory requirements, reportage, and the tried and tested business norms, practices, and knowledge. And while there are calls to move from conformance to performance, or maybe just balancing the two, in the Philippines, there is a strong resistance or inertia that was caused by different factors. So these are the different factors enumerated by ICD. The first very notable observation is that Philippine firms tend to have a compliance-driven mindset. It's because corporate governance in the Philippines was institutionalized through regulations and reporting standards that companies had to follow. Philippine publicly listed companies focus on reporting guidelines, transparency, and disclosures. But ICD now sees that substance is more important than the form, and therefore there is now a need to look at the non-financial performance components. The second one is about reputation and reputation building. Companies aspire to get recognized in their efforts through placing in ranks, getting awards, and their definition of corporate social responsibility is still through primarily philanthropy and participation in what we call leading edge activities, whether it be commitment to get to net zero, renewable energy, shared prosperity, and cybersecurity. All of these are publicized to establish good faith and good community standing. However, these are also prone to overstatements, making unsubstantiated claims, greenwashing, or pledges with very slow uptake or delayed follow-throughs to the community, among others. The next one is their lack of awareness on the importance and implications of stakeholder value creation. Philippine companies sees these as aspirational, but they have a difficulty of envisioning its long-term gain or benefit to the firm. And the lack of motivation, therefore, is also due to the absence of concrete and proven practices. This is related to the Philippine firm's behavior or a compliance-driven mindset. For instance, the SEC has released sustainability reporting guidelines among publicly listed companies. However, the absence of concrete and proven practices that show significant impacts to business governance and operations only led to surface level performance indicators, and therefore the lack of motivation on the side of businesses to do better. And finally, there is the hurdle of allocating resources to stakeholder value creation. If they couldn't envision what their gain is, or the long-term gain is from creating more value for stakeholders, firms found it to be difficult to allocate resources, be it financial or even human resources, to these efforts. So how then does ICD propose to push boards to overcome this conformance inertia? Apart from the Institute's objective to source out professionalized independent director candidates to corporate boards, the Institute's programs that we enumerated earlier have been continuously developed to push against what was identified as conformance inertia. The first set of programs is their corporate governance education and thought leadership. They hope to address this hurdle by preparing companies for future regulatory requirements that would involve stakeholder value creation. So for now, the current push for ICD is to campaign for the sustainability reporting standards. Now, the SEC sustainability reporting standards are also a combination of the different frameworks that we currently have. And since this is very new, for publicly listed companies, ICD hopes to get their buy-in by doing the roadshows and the workshops, especially since they are accredited GRI professionals. They hope through these programs to increase the company's reputation by recognizing their efforts, best practices, and showing them as case studies in trainings. ICD plans to realign their priorities by raising awareness on the benefits and implications of stakeholder value, to introduce trends and proven practices that firms can also adopt, and to inform companies of both not only the financial, but also the social benefit of stakeholder value creation to the firm. In terms of board evaluation and their strategy execution pathway, ICD plans to address the board's compliance focus, their need for reputation building, and their lack of awareness for stakeholder value importance through both board governance evaluation and this strategy execution pathway that make more long-term and impactful stakeholder value creation a part of corporate strategy that will build more meaningful and more lasting firm reputation. So this is now going beyond compliance. The lack of motivation is also addressed by introducing emerging trends and proven practices. And in terms of resource allocation, both ICD programs would provide the framework for resource allocation decisions and stakeholder value creation. And finally, ICD pushes its advocacy through its committees. And these committees would also serve as recommending bodies and technical experts that would push companies through the board to cultivate a culture of stakeholder value creation by sharing best practices in their own corporate strategies and organizational culture. And as thought leaders and advocates, the committees conduct studies and recommend standards of practice suitable to Philippine business environment and conditions. And it is also through the concerted efforts of these committees that frameworks for governance and resource allocation in the interest of stakeholder value creation are made. So to sum up ICD's efforts, ICD Philippines plans to aid Philippine businesses in this transition to stakeholder capitalism by raising awareness on the importance and benefits of the stakeholder value creation to the firm, enable companies to incorporate stakeholder value creation in their corporate strategy, and to demonstrate genuine stakeholder commitment by recommending a framework for resource allocation, and of course, cultivating a culture of stakeholder value creation. And that ends my presentation. Thank you.
Thank you very much, Lara. That was a very, very interesting case study. I was wondering first if there's any questions among the participants, any raising hands? Okay, so I will start. Lara, based on your results and the job of ICD to overcome conformance inertia, what do you think has been the most successful of the actions taken to incorporate stakeholders in corporate governance?
It has been the corporate governance education. ICD is very unique since it plans to recruit different fellows in order to become the source or the pool, the top of mind pool of independent directors across different companies. And some companies rely on ICD in order to spot current developments, trends, etc. Because companies in the Philippines, even publicly listed companies, do not really want to spend some resources in trying to do some research on their own on the corporate governance trends. So that is ICD's niche, and that is where ICD tries to implant its campaign of stronger corporate governance, of new trends such as sustainability, in order to not only create surface level key performance indicators, but to really change the culture and mindset of corporate governance in the Philippines. So that is their primary niche.
Yeah, thank you very much. That's very interesting. And we have 10 minutes of Q&A, and as Julia is saying, until the break. So we have plenty of time and room for questions. It's either you can feel free to direct questions either to Lara, but also to the previous presenters, or to make a question to the three of them if you feel like. Just raise your hand or even just unmute yourself and start talking. Just another question, because you say that education has been the most effective in the primary work from ICD. But in your opinion, Lara, what is the measure that has not been developed yet that you think that should be developed? What is still to be done to incorporate stakeholders?
Well, in the case of the Philippines, the hurdle is, as we said, it's conformance inertia, and firms tend to just look at the surface level indicators in order to have bare compliance with the reporting guidelines of, for example, the SEC or other regulators. What needs to be done is to have concrete measures that are applicable to the operations of the different industries in the Philippines. We need to incorporate measures that are not just about, for example, in terms of board diversity and inclusion, how many women are in Philippine boards. Now, that is not enough for us to measure that, well, there has been a significant change in governance in the Philippines because there are just more women on boards. But we need more specific and concretized measures that are still yet not to be discovered in terms of diversity, inclusion, cybersecurity, etc. It's the concretization that is really a big challenge, both for ICD and the regulators. Now, that's why it is still, well, there is a presence of sustainability reporting guidelines, for example. It is still very surface level, and they still need to find more ways to measure impact concretely in the different firms.
Thank you very much. I see that there are questions in the chat, but Adetutu was first to raise her hand. So can you just unmute yourself and ask?
Yeah, thank you very much. And thank you to all the speakers. My question is directed to Ants and on the community governed capitalism. I was just wondering about the organization of the community, because when you refer to investors, they are much more organized as a group of people. But now that we talk about community governed capitalism, how organized would the community have to be for us to achieve the right objective? My other question is, at the moment, there are some policies that have been set up to govern investors and investments. So with this new shift, how would this impact existing policies, for it to indeed fly? Thank you.
Thank you for your question. to start with, we think that there would be a need for an entire ecosystem of players to ensure that community governed corporations can exist and thrive. So let's take for creations for a new company. Let's say we were talking about a new company in an underserved community, for example. We would probably want to incubate that through a community-based organization, for example, that is already serving the community, perhaps philanthropically. We would need an incubator of sorts, kind of an incubator accelerator type organization that could be funded by an investor or by a donor through the community-based organization or independent of it, that can help the new company develop its market advantage, develop its business model, develop its prototypes, develop customer acquisition, for example. And then you would need a group of funders who are willing to take the risk on that and to invest as investors initially, and then have a predefined exit at some point down the road. Now, if you look at foundation capital, typically disperses only about 5% of its, assets in a given year. Something like this might unlock more capital because it's capital that could potentially be recycled. It's not just a grant. And if we were to look at this as a portfolio approach, imagine if there was a fund that invested in 10 or 15 businesses in a community, well, then you would have some diversification within that portfolio. And potentially, the risk reward ratios will work out for an investor. So we think an entire ecosystem is required for this. It's not going to be simple to pull off. It's not going to happen overnight. It's going to require a lot of intention. In the case of a conversion, a CGC conversion, let's say we were looking to flip, I'll just use a controversial example. Let's say we were looking to flip Philip Morris, and you wanted former addicts and public health experts on the board of Philip Morris, so it didn't push the inefficiency so hard, for example. Well, you would need an organizing body to bring stakeholders together. Perhaps labor advocacy or consumer advocacy firms might find this meaningful work to bring together stakeholders. You would need bankers and accountants and legal experts to help structure a deal, to make an offer to existing shareholders. And you need a stakeholder committee that can actually become the body that nominates the first board of directors once the company is flipped. So there's quite a bit involved here, and we outlined that in some detail in our paper. As it relates to new laws or reporting requirements for investors, I mean, depending on the country, there are lots of different things going on. In the US, for example, there are new regulations coming out or that have been proposed by the SEC for disclosure around emissions or ESG reporting. We don't see any of that as being sort of, profound at this particular stage. It's fairly modest in terms of the change that we think is possible through a community governed institution. We think it's very, very different. For example, the SEC's proposals on emissions reporting only factor in scope 1 and 2, but not 3. 75% emissions come from scope 3. So I would characterize those as modest suggestions, not foundational suggestions, whereas the idea of a community-based organization can shift things more profoundly. Bruce, any thoughts from your side?
Thank you, Hans. No, the transaction of pulling off a CGC creation or a conversion are non-trivial, but there are pools of capital and certainly people and stakeholders who are interested in seeing something like this happen. The point that I think Hans made, and I would stress, is the whole idea is to create corporations that are, if you will, taken out of the permanent fiduciary duty to shareholders model, so that they can focus more broadly on the needs of their stakeholders. And any model that leaves ownership and fiduciary duty to the shareholders, the stakeholders are supplicants. There's no power, there's no control. So this is a way where you can change that control. And in the case of conversion, if you can make an attractive enough offer to a firm, the board has to sell to you. That's their fiduciary duty. So we're talking about really changing ownership and control and charter within the market context.
Yeah, thank you very much, everybody. It's 19:59, so we have to go to the break soon. We have 2 more questions on the chat, so I don't know if you can answer them super briefly. To Lara, that's from Habib. Thank you for the presentation. I was thinking how much of generalization can be made from your case study.
Thank you, Habib. In terms of the generalization, the analysis of ICD on Philippine firms is really based on the country's context. So it's not only in terms of scope, it is more of a national one, although it will be not only about publicly listed companies, but all types of firms, even micro, small, and medium enterprises also have that kind of conformance inertia, especially them, since it is they who are really shouldering the risks of not being accredited by the SEC, etc. So it will be broadened up to them. But in terms of applying it to other countries, the Philippines has a very special context in terms of this conformance inertia. Thank you.
Thank you very much, Lara. So, Adase, that's the last question. Interesting analysis locating issues within the frame of corporate law. Is there an appetite for change of this structure as it is largely viewed as successful for insulating risks? I'm not sure to whom of the presenters do you want to show this question, but if any of you want to take it on it?
I sort of said it had been partially answered by the last group. So it was to do with corporate sort of formations and this new form of business that is being pushed. But it's fine. It partially mentioned answers that related to that. Thank you.
Thank you very much, Adache. So I've got a question about the recording, and we will after we have a couple of minutes still, and then we will share the report with us conclusions of all of the discussions that we had. So there you will have notes of what we have said in each of the sessions. And yeah, we may have a couple of minutes left. Is there any last question that we can make that can be made and answered within 2 minutes?
If I can quickly ask a question. I think Hans left already, but maybe to Bruce now. So I was thinking, if we are talking about this shift, I would expect that there will be quite some resistance from shareholders, especially. So of course, keeping in mind that also these shareholders are members of the community, right? They are not just aliens. So how much of consideration are you giving to that fact that they are still also, if you are saying community governed, and the existing company is not governed by community? Because of course, a shareholder is also part of the community. So how are we trying to not just over define these groups and not exclude certain individuals because of conditions or other situations that abound?
That's a great question. I'll answer it in 27 seconds. We think the primary targets for this kind of a program in the near term would be privately held businesses where the proprietors want to retire out of the business and leave the business in good hands. That we think would be a friendly target. Number 2, starting businesses in a community in need would be backed by foundation money, community boards, and people with an interest in preserving the integrity of the community. Maybe around an anchor institution, like say New York University